If you're having trouble sticking to stops, try this. Hey traders, warm welcome to you. Alright, so I get a lot of questions about this, and I get this. Like, you have trouble sticking to your stops. You know you should have a stop loss in. You know the rules. You know all about risk management, but for some reason you don't stick to the stop. You don't put a stop loss in. You move the stop. Whatever it may be. The point is the risk management isn't as solid as it could be. Whatever it is, you're just not honoring that stop. And you're probably beating yourself up about it. You're probably frustrated about this. You're probably annoyed. Why can't I just stick to the stop? Why can't I stick to the rules? It's annoying. And everyone's going to tell you, just use your stop. Just use your stop. And, you know, I say the same stuff in videos, guys. I know I do. I say, listen, keep your risk managed, etc., etc., etc. But it's like telling somebody who's overweight to stop eating cake. Yeah? They know they need to stop eating cake, but they can't stop eating cake. It's like a smoker who wants to stop, knows all he's got to do is not stick a cigarette in his mouth and light it, but it's hard. I get it, it's hard. So we need to come up with something that just starts the process. What you can't do is sit here and just say, I'm not sticking to my stops, and say, I must stick to my stops. I must stick to my stops. You go in the next day, you break the rule again. You can't have that cycle. You have to do something, a small step that just upsets that balance and puts you on the path so you can make subsequent steps so that you've got ironclad discipline. Now, I could sit here and I could say, hey, you know what, it's not in your best interest, you're going to lose money. You go, I know that, I know that, I know that, but you're still doing the wrong thing. So this is a very useful, practical tip to take to start the ball rolling to improve your risk management. We're not going from zero to full risk management. We're doing something very small just so you can build on this. So for those of you watching saying there's no use, yes, on its own it's got no value, but what it does is it starts to get you in the mindset and the frame of mind to using a stop and sticking to it and not having cognitive load and doing all the things so that eventually then you can get better at it and better and better before that problem is long gone and you're focusing on other things to improve as a trader. So this is what you do. Let's say, for example, you are day trading, and I'm going to look at swing trading in a second, the Japanese yen. You day trade in Japanese yen, and whatever market it may be, this is just for example here, and you're just not sticking to stops. The way you combat this is this way, but it actually has two benefits. First of all, you go to your daily chart, you flick on indicator, you go onto your average true range, you select 1 on the average true range. It's going to give you the average true range of one day. I like to change it and thicken it up a bit and make it a histogram just for visual purposes, but I recommend you do the same as well because it's easier to see. And make the colors whatever color you want, and then you look and you see what the average true range at the moment is for Japanese yen. Now, you should probably take the largest of the last 5 days. If it's super large, then maybe you don't need to do it. If it's not super large, then you can get away with it. Another thing you can do is you can kind of round it off to 5 days. Let's do that. That'll give us an average. Let's stick with that. So 5 days ATR at the moment on this is, what's that? It's 60 pips. Right, the average range in a day is 60 pips. It's gone up to 70 odd pips, so I'm going to take the highest of the last 5. So I'm going to stick with 70 pips. So now what I do is I always use a half of the day's ATR. Now this is going to vary depending on the type of trader you are. If you're the type of trader who's scalping a lot, use half of the day's ATR. If it's someone who's looking for 1 or 2 big moves, use a full day's ATR. Now, you may be thinking to do what with? We are going to put an automatic stop loss in at 70 pips, at 35 pips. Okay? You need to decide which one it is. The point is, this is the only choice you are getting. You decide to use 35 pips or you decide to use 70 pips. Now, the results that you get out of this are going to be mixed and variable, but What you need to do is next time you take a day trade in the US dollar JPY, you do not even think about where the stop is going to go. You do not even look at where the best placement for a stop is. You do not even consider resistance levels, prior highs, prior lows. You just stick it in at 35 or 70 pips away, and you must adjust your position size to suit. So 70 pips seems too rich for you? Good. Reduce the position size. This is the second advantage. The second advantage is that it reduces your size when you're trading dangerously, because no risk management is trading dangerously. So you reduce your size and you fix that stop. And what you do is you run with that for at least a couple of weeks. Dial the size down, keep that fixed stop. You don't have to do anything. All you do is take your trade, make your decisions as you're doing already at the moment, but then you just put a stop in 70 pips away. That is it. You don't do anything else. Now, if you decide that later you're going to come out at a different level that's more sensible, you can do that, but that is in week 2 only. Week 1, you let it go and you let it stop you out if it goes against you. Now, this isn't going to be the most powerful strategy in terms of profitability in the world. It's probably got a negative expectancy. However, what this does is it gets you into the habit of placing a stop in, putting a stop in, not thinking too much about overthinking it, because that's generally the issue as well. You're overthinking the stop, and when you put it in, you don't believe that it was the right thing, and you move it and you pull it. This is going to be a decent number of pips away. Is why I always recommend going for that full ATR rather than half, unless you are a really aggressive scalp, in which case 35 is going to be quite a big range anyway. It's got to be big so that when you get there you think, well, actually the trade is definitely negated because the move is massively against me and it's taking me out for 70 pips loss. And you may be sitting here thinking, I can't take 70 pips loss. Yes, you can if you dial down the position size. This is something that will ingrain in your mind that you should put a stop, you should stick to it, and there's no decision making process to go on. When you've done this for 2 weeks and you've not moved your stop, you've not altered it, you've not cancelled it, you've not done anything with it, then you can say, what, I can do it. I can stick a stop in and I can hold it. Look, I've proven it for 2 weeks. Now, let me go to phase 2, which is to come up with a little bit more of a structured stop, i.e. below a prior level, this or that, whatever it is. Again, keep it reasonably wide, because very often it's a bit too tight. Keep it wide, then do that for 2 weeks. The point is, you want to remove the cognitive load that you have when you're trading intraday, and you want to make it a habit that as soon as you put that trade on, you put a 70 pip stop in. You don't have to stop and think about how far it is. It's like, listen, this week it's going to be 70 pips. You can do your ATR, maybe you can do it every 4 days, whatever it may be, but before you take a trade what your stop's going to be. And exactly the same thing for you swing traders. If you're a swing trader, you're swing trading currencies, you do the same thing, but you do it on the weekly chart or the monthly chart, depending on how long you hold stuff. You look for your top 5, 150 pips, round it up, there's your stop. 150 pips. If you do it on a monthly chart, which is probably better if you're holding stuff for a little bit longer, what's it going to be? 400 pips. Seems excessive? Well, if you're looking for a 4 or 5 week move, that's what you're going to have to put up with. But I think this is more of a day trader's problem than it is a swing trader's problem, because it can be exaggerated so much more in day trading, in that when you miss the stop or you don't use the stop, it can be 4, 5, 6 times the loss than you expected. Whereas a swing trader, you've already got a pretty wide stop, and if you don't stick to it even one more day, unless it's absolutely running crazily, you're still going to get away with it. So it's generally for day traders, so this is aimed more than likely at day traders. But go out there and try that. If you're having trouble with your stops, just try that. Very structured, very simple. Step 1, you get your ATR on a daily. I would recommend actually doing it to 5 to again reduce the cognitive load. Set it to 5, set your style so you can see exactly what it is. Take the highest you've got from the last 5 days, set that as your stop loss, and use that as a stop loss going forward. And if you can do that for a long period of time, then you're ready to improve and improve and improve. The first step is just making sure you stick to some kind of stop, and that's the point of this. All right, guys, take care. See you in the next one. Good luck with it. Bye-bye.